Our next speakers are with the owners of Keystone CPA, Matt MacFarland and Amanda Han. It's been my privilege to speak with them on a number of occasions, and I actually saved money because of them, and that's one of the reasons they're here. I like hearing things that I didn't know, and that's they're very sharp. You guys just won an award, didn't you?
We did.
What is it?
Top CPA of Orange County.
Top CPA of Orange County. That must not be easy to do. So welcome. We're glad to have you here today. Thank you.
Well, thank you, Bruce, and thanks to the Norris Group and to Aaron Norris for putting on this beautiful event. And obviously, this is a gorgeous facility. So if you could give a quick round of applause for the Norris Group, we'd appreciate it.
And, sorry, I'm very loud, I feel. Now that your tummies are full from breakfast, they bring up the tax people. So hopefully you guys will stay awake for this presentation.
And just to let you know, too, all the speakers, we're going to take questions at the very end. All the speakers are going to come up, and we're going to do a Q&A panel at the end. So if you guys think of questions throughout our presentation, or if you have questions from Bruce's or Karn's coming up next, just write them down, and we'll have plenty of time at the end to answer the questions. So to kind of get started, we all know that we're facing uncertain times, right? We've got a very tight presidential race that's coming down to the wire in a week and a half. We've got a lot of tax changes that are going to take effect January 1st, which we're going to go into. There's this looming fiscal cliff that's where they're supposedly going to put spending limits on the federal government starting January 1st as well. And our national debt is obviously at an all-time high. So with these uncertain times, what we want to do today is talk to you about solid tax strategies that you can put in place now to protect yourself from the rising taxes, protect yourself from the uncertainty, kind of know what's coming up.
So let's quickly go over the agenda today. First, we're going to be talking about taxes, past, present, and future. Then we're going to be talking about some old strategies, some solid strategies that you've used in the past which may no longer work.
We're also going to be talking about specific tax planning ideas that you can put in place in these uncertain times, things that you should be looking at with your advisors, especially before year end. And one of the biggest takeaways that I hope you guys get from today's event is look at your opportunity for tax-free income strategies. And at times of rising taxes, now is a really good time to look at how can I lock in money that's going to be tax-free for the rest of my life. And then we're going to talk about certain action items you can take between now and year end to implement a lot of the things that we talk about today.
So before we get started, everyone here has brought their financial calculators with them, right? You got that email? Because this is the next part here is where we get into the heavy math. So we're going to start with a pop quiz, so take out your calculators.
All right, so pop quiz. And
before we start,
yes.
We have free CD. So if you know the answer to this question, please raise your hand. The first person who raises their hand and gets it correct is going to win one of these CDs, Top 10 Tax Strategies for Real Estate Investors, okay?
So we're all smart. That means raise your hand. Don't yell the answer out, and we'll call on you. And obviously, too, if you happen to hear us speak before and you've won before, you can't win the quiz again because the questions, unfortunately, don't change. So the IRS allowed which of the following people to take a tax deduction for their breast implants after a court hearing? Is it A, Dolly Parton, B, Druggy Lohan, C, Chesty Love, or D, Bruce Norris?
Chesty Love, oh my gosh,
Chesty
yes.
Love is correct. Obviously,
Congratulations.
Obviously, A is a popular choice. But C, Chesty Love, actually, when Amanda put this together originally, I said, come on, that can't be a real name. That's impossible. But if you go to Google Images, type in Chesty Love, you'll see what we're talking about. And what's the best part about this, though? The IRS said, yeah, you can write them off, but you can't write them off right away. You have to write them off over a period of time. And why is that? Because they're fixed assets, and they have a useful life of longer than a year.
So it's depreciation just like real estate,
That's right. So our second question is, ABC News research recently revealed that the average American spends more money in taxes than they do in A, clothing, B, food, C, shelter, or D, all of the above combined.
This gentleman in the green? All of the above. That's right.
All of the above, that
we
is
make
right.
these too easy, Matt.
Got to make them harder. So this is actually, sometimes when we talk about this is actually kind of shocking to some people that they're losing, more in taxes than they do in all these things combined. But what if I was to ask you, how many people in the room think that we can't afford to pay higher taxes, or we can't afford to have tax rates go up? Now notice I'm not asking, do you not want to pay higher taxes? I'm asking, do you think we can afford to pay higher taxes? Anybody think we can't afford to pay higher taxes? Wow. Okay, so there's a few people. Now, would you also be interested to find out that if you actually look at historic trends over the last 80 years, that our tax rates today are actually, relatively speaking, historic lows? So, with our highest rate at 35%, that might shock you, but so let's look at a quick chart from the last 80 years. And this is from the taxfoundation.org. And the blue line is the top marginal tax rate for federal taxes for individuals. So you can see back in the early 70s, the top rate was about 70%. Now, does anybody remember those days? Okay, now with my gray hair, you might think that I remember those days, but I don't, unfortunately. But
And if you look back into the mid-40s, the top marginal tax rate for individual taxpayers was actually 94%. Isn't that amazing? That's just on federal income taxes.
Now, granted, you had to be making $2.5 million in the 1940s to pay 94%, but still, if you're making 2.5 and paying 94%, you're getting left with 150 grand. That should still be enough to live off in the 40s, right? But if you started with 2.5, you're going to be pretty upset if you're only left with $150,000.
So a lot of times, you look at historical trends to predict what might happen in the future. And I know, I speak as a CPA and as a taxpayer also that hopefully we never revert back to those days. So let's take a look. Earlier, Matt mentioned ABC News came out with, the research which showed that we pay more in taxes than food, clothing, and shelter combined. So how do they come up with those numbers? Well, let's take a look at what we're currently paying right now.
Yeah, you can see that the top federal tax rate right now is 35%. Here in California, our top rate is 10%. You've also got to factor in payroll taxes of 15%. You've got to think about capital gains taxes. Those are going to be changing. Those are currently at 15%. And our state taxes are at 35%. But what are you paying right now? What other taxes are you paying right now that are missing from this list? Sales tax, real estate investors, what else? Property taxes. And actually, we just read something the other day that California is considering imposing a new tax on soda consumption.
Are you guys aware of that? Yes. So anything sweet and bubbly, there may be another tax. And I believe it's something like 1 cent per ounce on soda taxes.
So yeah, those of us who drink Diet Coke like it's going out of style, we're screwed. Now let's look to 2013. The column here is if nothing changes with Congress and whoever becomes president, if nothing changes between now and year end, this is what the rates are going to look like on January 1st. So our highest rate's going up by 4.6% to 39.6. Capital gains taxes are going up by 5% to 20%. And the state taxes are jumping all the way up to 55%. Now you can see here at the bottom that another question is, well, what else is missing here? What are there's some new taxes that are coming out and we want to talk about, make sure you guys are aware of. So these are the two new taxes. Now let me ask a question. Who's heard of the unearned income Medicare contributions tax or the hospital insurance tax? Okay, there's a few. That's pretty average for what we find. Now, some of you may have heard of this referred to as the healthcare surtax. Anybody heard that thrown out there? The thing is, these aren't new. The law that put these in effect were actually passed back in 08 or 09, but they don't go into effect until January 1st of 2013. So what the unearned income Medicare contributions tax is, it's another 3.8% tax on top of all the other taxes you're paying, on top of federal income tax, on top of state, all that other stuff we talked about.
And this is imposed on anyone making $200,000 or more as an individual or $250,000 or more as a couple.
Right.
And again, it starts to take into effect in about less than 60 days, a little over 60 days. So I'm actually quite surprised that not more of you are aware of this tax. We've been teaching on this topic along with Bruce and Karin for, I think, the past 3 years. And so this is definitely something we need to be looking out for, especially as real estate investors, right? Because let's think about it. What is net investment income? It's interest income, right? And for real estate investors, what kind of income are we generating? Anyone? Rental income. That's also fallen under the definition of investment income.
You've got gains on the sale of your rental income, rental properties. Also, believe it or not, if you sell your primary residence, the gain on the sale of your primary residence might be subject to this tax too. Now, they're not doing away with the home exclusion where you can exclude the first $250 or $500 if you're single or married. But what if your gain is more than those exclusion amounts? The leftover amount that you have to pay taxes on is going to be subject to this tax. So when you look at that, we're going to talk about a strategy later in terms of interest income, a strategy to kind of mitigate this tax a little bit. But again, this is another 3.8% tax on net investment income. And this is after considering your expenses. So obviously for your rental properties, you get to deduct your repairs, your maintenance, your depreciation, your interest, all that stuff.
And then the other new tax that's coming into effect in starting January is the hospital insurance tax. How many of you guys know what the hospital insurance tax is? Nobody? My goodness. Well, it's not assessed on hospitals, I'll tell you that, and it's not assessed on insurance companies. It's actually a tax that's assessed on all of us here in this room. So same criteria, $200,000, $250,000 or more. This is on all earned income. So that's W-2 income, 1099 income, anything that's not investment income is considered earned income, okay? So don't let the name mislead you. It's a tax, an additional tax on earned income imposed for the individuals, not for hospitals, not for insurance companies.
So again, these are the new taxes that go into effect January 1st that you should be thinking about now, where to plan strategically to, A, find out if you're going to be subject to taxes, and B, what are some things you can do to kind of mitigate or avoid the tax starting next year. Now, we obviously don't know who's going to win the election. Some of us may be able to think they can predict that, obviously, but it's obviously a very tight race. And with a lot of the uncertainty out there, the government is obviously going to have to try to raise revenue at some point, right? It can't continue on the path that they're on. And one of the ways, obviously one of the most talked about ways they're looking to do that is through tax rate changes and changing taxes.
Now, how many of you guys think that if one candidate wins versus another one, that we would be paying lower taxes? Please raise your hand. Not a lot of people? Okay, so let's look at what each candidate is really proposing in terms of the tax changes.
Yeah, and obviously one candidate is looking at raising tax rates. He wants to raise it for high income earners. He wants to raise it on capital gains. He wants to raise it on dividends. He wants to raise it on estate taxes. And obviously those new taxes that we just talked about as well. Now the other candidate is actually talking about lowering tax rates. Obviously at the first glance that sounds really good. But again, this isn't a revenue raising. Overall, the plan is to raise revenue and improve the economy, right? So his plan is to make up for it in other areas, and those are by taking away some of our deductions that we come used to. So that might be taking away some of the credits. That might be putting a limit on charitable donation deductions. You might put a limit on medical expense write-offs. They're actually also talking about maybe putting a limit on mortgage interest deductions. Now, you might be surprised to find out that the mortgage interest deduction is actually the second largest cost to the federal government in terms of individual taxes of anything else, and that's at about $91 billion annually.
So I know a lot of people that we speak with say, you know what, our ability to deduct mortgage interest on our taxes, that's like an American right? We should be able to do it. How can they even consider taking that away? Well, the truth is, both candidates who are running right now within their proposals are either looking at significantly reducing or putting a cap on mortgage interest deduction or itemized deductions as a whole. Okay, so that's something that we need to be aware of, not just focusing on the tax rate changes, but really, we all know at the end of the day, we're talking about trying to balance the budget, right? Raising revenue from all of us here.
Yeah, so at the end of the day, it's pretty foreseeable that taxes are going to change. Now, whether the rates themselves go up or down, at the end of the day, it's pretty certain that I think taxes are going to go up. That's our opinion, it's a lot of people's opinion. But with this uncertainty that's out there, and in terms of the politics and the tax rate changes, and even though each politician has their own set of tax policy platform, it's important to know that there are things you can do in these uncertain times, strategies you can put in place to make sure you're protected.
And we start with, well, what are some of the things that we know that are certain as we sit here today?
So the first one is the current lower rates and the loopholes that are available for the 2012 year. Nothing's happening there. Nothing's going away for the 2012 year. So come next April when you're filing your taxes, Nothing's going to have changed with the 2012 rules themselves.
So we still can use all of our deductions. This year, there's still bonus depreciation on any new assets you're buying for your business or for your real estate or any leasehold improvements. Okay, that's still available this year. Nothing's going to change on that, no matter who wins the election. Another thing that we know for sure is that total taxes is not going to go down in 2013. Can we all agree on that? Okay.
And also, the two new taxes that we just talked about, those are becoming effective January 1st. Now, obviously, depending on who wins the election, that person may try and repeal these two new taxes. But again, that's not going to happen before January 1st. So the thing I think you need to take away is that you need to plan for what's set to happen and then adjust accordingly as things move forward.
So to that extent, we know what we don't know, and we know what we know, right? What are some of the things that we should be doing today, or we could be doing today, to protect ourselves? One of the things that I highly recommend for most of our clients, and especially in today's day and age where there's significant changes, is year-end tax planning. How many of you guys in the audience do year-end tax planning?
So, in other words, you meet with your advisor before year end, they kind of do some analysis, some calculations with you, provide you some recommendations on actions to take before year end. So a decent number of you guys do that. That's good. Mm-hmm. Well, kind of give you an analogy of kind of what year end tax planning is. Let's look at a basketball game. Let's assume the Lakers are playing the Clippers. Now, if you're a diehard sports fan or you're a diehard Lakers Clippers fan, obviously you care what happens throughout the game. But at the end of the day, what really matters is what the score is when the clock strikes 0, right? That determines who the winner of the game is. It's kind of the same thing with taxes and your finances. Where your finances are on December 31st determines, for the most part, what your taxes are going to look like come next April.
So what are your numbers say? Have you sold a property? Have you purchased a property? Did you already make your repairs and improvements, right? If all those were done before or after year end, that determines a lot about how much or how little taxes you'll be paying. In speaking of planning, it's important to know what we've noticed is that a lot of these traditionally strong tax strategies that you may have heard in the past may no longer work or may not be as ideal. And it's really interesting because actually, this is the second annual brunch event. So Matt and I were up here about this time last year talking about some strategies. One of the favorite ones for year-end planning for some of our clients in this room, you might know, is the concept of income deferral, right? It's your ability to defer receiving income from December 31st to January 1st of the following year. By delaying that for just even one day, you could be delaying the taxes on that income for a whole entire year. So that's a great strategy. But that strategy may no longer be something that's ideal for you in today's climate where there's going to be some pretty big changes to the tax code.
Yeah, so let's look at an example of let's say you're operating a C corporation. Or let's just assume that you actually are investing in a C corporation. You're looking to get dividend income or dividend payouts from the C corporation. If you wait to receive that money until 2013, you could end up paying up to 30% more in taxes on the same dollar of income that you receive versus if you received it in 2012.
Because dividend is going from 15% up to about 43%.
Yeah, the top rate on dividends is going all the way up, could go all the way up to 43.6%. So assume you get a $10,000 dividend. That extra 30% in tax could mean you're paying another $3,000 more in taxes on the same dollar of income, just because you deferred it until January of next year. So these are the things you need to be looking at with your advisors and kind of talking through and figuring out what's going to happen now, and not just what's happened for 2012, but what do you expect happening in the next 6 to 12 months of your life and your business and your investments. Now, I'm going to probably ask a silly question, but how many of you in the room are real estate investors? Okay, so like 150% of you. That's what I thought. But
Matt's really good at his math.
That's why I need a 10 key. But so let's talk about a couple strategies, income deferral strategies that we really like as real estate investors and we're really used to using. So for instance, a 1031 exchange. So with a 1031 exchange, the goal is we sell a property, we buy a replacement property, and we can defer the taxes and the gain on the sale of our property until a future year when we sell the new property, right? Well, again, with taxes going up, that strategy may not be the best for you right now. I mean, because you look at it, you might end up with tax rates, capital gains taxes changing. You could pay anywhere from the 10 to 24% more in taxes if you utilize that strategy. Now, granted, if you're going to sell the property and hold another one for 10 years, Obviously, the time value of money and the savings you're getting from deferring the gain for 10 years, that works. But let's take the example of if you sell a property now, say you have a property you're going to sell for, you're going to gain is $200,000. You buy a replacement property, and for whatever reason, you need to sell that property in 2 years. And let's just assume you don't have any profit on the second property, so your overall gain is still $200,000. That could equate to anywhere from $20,000 to $30,000 more in taxes that you could pay just by deferring the tax on that first sale. So it's really important that you should sit down and run the numbers with your advisor to find out if that old strategy still works for you.
I mean, if across a 2-year period, if you could be saving, anywhere about $20,000 in taxes, that's pretty significant, right? We can all agree on that. I mean, $20,000 could be down payment on another rental property you own. Or maybe if you go to some parts of, Ohio or Michigan, that could be an all-cash offer on a property that you hold. So that definitely could make a huge difference. Another thing is installment sales or seller financing. For any of those involved in those kinds of transactions, similar concept. Traditionally, we talk about deferring the income into future years until you receive it. That may no longer be the most ideal situation for you, depending on what tax rates happened to change and also what deductions people are taking away. But the good news is, when it comes to taxes, there's always strategies you can use to change that, right? You can change and elect out of an installment sale method, okay? And same thing with 1031 exchanges as well. You can always undo a 1031 exchange if it doesn't make sense for you. The key is to make sure you're meeting with your advisors if you have these kind of transactions to say and run the numbers and talk about, does this still make sense for me? Not just in this year, but looking across maybe the next 2 to 3 years.
So some of you may be shocked to learn that we have actually less than 50 working days before the end of the year. So that's why it's really important for you to sit down with your advisor. I mean, we've talked about taxes in the past, the present, and what we expect to happen in the future. We talked about the uncertainties and the uncertainties. But we're also going to we want to talk about, the good news is there's still other strategies out there that work. They'll still work in times of tax rates going up or tax rates fluctuating and things like that. So we're going to talk about a few of those right now.
So the strategies all work regardless of who takes office and what happens to tax rate.
So the first one that we really like to emphasize and talk about is income shifting. And in income shifting, we're talking about here is the ability to shift income from your high tax bracket to your kids or maybe some other family members' lower tax rates. Now, obviously, why would we want to do this? What are the benefits of doing this? Well, non-tax benefits, that you can get your kids to help you in your business. It's going to teach them a sense of responsibility, good working habits. And then obviously the overall goal is that we can save taxes, right? So if you can shift taxes from your high rate of 30 to 40% down to your kids' 0 rate, that's a good savings for you. So as an example, we'll talk about our client, Erin. We met with her last year, and we were going over year-end tax planning, and we were just chatting it up with her during the conversation. What are you doing on the weekend? So I'm going to take my son out to some of my properties. Now, she's a full-time sales executive, but she has a business of doing fix and flips on the side. So she was taking her son out with her to do some repairs, some cleanup, some painting on these different properties, and they were going to do that for, I think, the next 2 or 3 weekends. I said, okay, well, that's cool. Have you thought about putting your son on payroll and paying him to do this? And, she hadn't even thought about it. And so that was the opportunity that we worked with her on, is that we legally incorporated her son into her business. She put him on payroll, and she ended up paying him $5,000 for the work he did. And based on her high tax rate, she was federal and state, she was paying 38%. That saved her almost $2,000 in taxes. And based on her son didn't have any other earned income, so he was able to not have to pay any taxes on it at all. The other cool thing is that now that he has earned income, he can actually put money into a Roth IRA, right? So imagine a teenager starting a Roth IRA with 60, 70, 80 years of tax-free growth there. So it was a good opportunity for Erin. But the thing you guys keep in mind is that the documentation needs to be in place before year end. So whether you put them on payroll, whether you pay them as a 1099, the paperwork and the transaction needs to take place before December 31st.
What I love about income shifting strategies, and it's, whether you're paying kids or grandkids or just other family members, is that for the most part, this is money you're giving to them anyways, right? If for any of you who have kids or grandkids, it takes a lot of money to make them happy, right? They have to go to the movies, they have iPods and iPads and iMac. I don't know if that's a word. But things cost money. And so one way to my sound? One way to write those off is to have them help you out in your real estate business, pay them, and then have them use that money to go out and buy all the things that they need.
Now, a couple of frequently asked questions we get in this area is, well, does it have to be just the kids? And we kind of alluded to it earlier. No, it doesn't have to be kids. It could be other family members. I mean, a lot of us have parents that are nearing retirement age or in retirement age, and they're looking for something to do. They're still active. Well, you can get them to help you in your business as well. Now, I don't know if you want your parents working with you or not, but I mean, that's a decision you have to make. But it works with them, too, assuming that they're in a lower tax bracket than you are. And the other one we get, too, is, well, how old does the kid have to be? Well, I mean, I guess my response is always, or our response is always, have you seen those diaper commercials? I mean, kids are getting paid, right? So the real answer is that the age needs to be appropriate for the work that they're doing. So you can't try and tell me that your 3-year-old is your IT consultant or something like that, I mean.
But maybe your 7-year-old is your IT consultant. You never know.
So it just needs to be appropriate for the age and for what they're doing. You need to, document what they're doing and what the work that they're doing and all that stuff. So
yes, and the key here is year end. If this is a strategy that you think applies to you, make sure you're meeting with your advisor before year end, because I do have people who hear us speak and then they want to work with us come April and they say, hey, I heard you talk about income shifting and paying your kids. I like to do that for last year. I said, no, you can't do that anymore. The year's over, right? But we're lucky because today, as we sit here today, we still have, how many, 50 you said? About 50 working days that you can still be working with your advisor on to see how can you shift income and lower your tax burden.
But keep in mind, though, that some of your advisors, they may actually like to take vacation at the last week of the year, so 50 working days might actually be cut down a little bit. So now the next strategy we're going to talk about, this one is just a kind of a fancy way of talking about how are you taking profits out of your business?
How are you paying yourself?
How are you paying yourself? Are you doing it by design? Is there a strategic way you're doing it? Or are you kind of just doing it fly by the seat of your pants? Or are you doing it by default?
Yes, because how you take money out of your business, whether it's a real estate business or manufacturing or if you're a doctor's office, how you take money out of your business could impact how much or how little taxes you pay.
So give you an example of one of our clients, Ben. When we started working with him 2 years ago, he has a business where it's a B2B business where he helps other businesses cut back on their expenses. So obviously, as the economy took a downturn a few years ago, his business flourished because everybody was looking for ways to cut expenses. And so when he came to us, he was living a good lifestyle. He lives in the South Bay, drives a nice car. He was making, I think, about $200,000 a year. But his bank account obviously didn't show that because he was losing most of it to taxes. Now, what he was doing he was actually paying himself all the profit out as a salary, W-2, subject to payroll taxes. And he just thought that was what he had to do. He'd read that he's got to pay himself a salary and assumed that he had to take the whole thing out as a salary.
So when we started working with him, one of the strategies we put into place right away was actually to minimize his salary, right? We wanted to keep it as low as possible. But instead of just, you might be thinking, well, he still needs the money to live. He can't just leave it all in the company, right? But what you do is you look at other tax-efficient ways to take money out of your company. For example, for Ben, he was an S corporation. He could simply take money out as a distribution. Distributions are not subject to payroll taxes. And so just even with that one little tweak, he was able to save close to about $10,000 in that first year. And keep in mind, this is so powerful because this is an annual saving, right? So every year that he knows how to maximize that salary versus distribution split, he's going to be saving on payroll taxes. And the more money he makes, the more money he saves.
And here's another tip, too, if you're looking for tax-free way to pull money out of your business. If you guys if you have a qualified home office that you work from, look at implementing an accountable reimbursement plan, which would allow you to have the business reimburse you for a percentage of the cost associated with your home office. The company gets to take a tax deduction for that money, and it's tax-free income, tax-free reimbursement to you.
How many of you guys have heard that taking a home office deduction is a red flag from the IRS? Okay. The best part about using an accountable reimbursement plan to reimburse you, for the company reimbursing you for the use of that home office, is that from a tax perspective, it never even shows up as a home office expense on any of the forms that you file. So not only is that a great way a tax-free way, right, to take money out of your business, but also it helps to protect you, or, well, not protect you 100%, but it helps to minimize your audit risk for those of you who work from your home, okay?
So it's a great strategy, and you'd be surprised at how quickly the numbers add up and what the savings can be for you.
I think on average, home office typically say for our clients is anywhere from $1,200 in taxes or up. So that definitely could be really significant.
Now, one of our favorite strategies to talk about is retirement planning and retirement investing. Well, let me ask you guys a question: if you were to put money into a bank these days, like a CD, money market account, whatever it is, what kind of interest rate are you getting? I mean, 0.1%, negative? I mean, whatever it is.
And you're not happy with that, right? Then that's why we're all here. We're all investors. We're learning how to make our money grow. What if I told you that I have an investment, or I have a deal for you where you give me your money, your return on investment is 0. And in fact, you're never going to see that money back. How many of you guys want to take my deal? And nobody? Man, I need to get a different job.
No takers?
But this is what happens if you think about it on money that you pay to the IRS, right? You don't ever get that money back. There is no return on investment. The return on investment is 0. So if there are opportunities for you to, instead of give your money to the IRS, instead put that towards your retirement and invest and grow for your future, isn't that a much better option that we would want to do, right? So this is a concept of retirement planning. Put money in your retirement account, get a tax deduction, right? But you haven't lost that money. That's still your money. It's now in a retirement account, and it invests and grows for you tax deferred.
So it kind of puts some numbers to it. We have a client, Ron, that he invests in the Long Beach area, and he also invests out of state. He buys rental properties. And we work with him each year, and he has his business. And each year we sit down with him, and we obviously work on ways, how can we maximize your retirement plan contributions? And for him, based on his business and his profit every year, he's able to put in about $40,000 a year into his retirement account. And this saves him anywhere from $15,000 to $20,000 a year in taxes, depending on the year. But the cool part about this, as Amanda was saying, this isn't money he's losing, right? This is still his money. If he's utilizing self-directed retirement accounts, so he's taking that money in his account, turning around and investing in rental properties. And I think the most recent one he bought was an apartment building in Oklahoma. So all the cash flow that property is generating is going back into his retirement account, and it's free of current taxes for federal and state. It's free of payroll taxes. And then obviously he's going to pay taxes on the money when he pulls it out of retirement, but he's getting that tax-deferred growth over the next 30 years. The other cool thing is that the money that's earned in your retirement, as I mentioned, is not taxed right now, so it's not subject to that investment income is not subject to that 3.8% tax we were talking about earlier. And when you pull the money out of his retirement account, at retirement age, that income is also not subject to that 3.8% tax.
There are a lot of different types of retirement accounts out there. I know that we're all probably familiar with IRAs, $5,000 per year you can put in, but there's so much more powerful ones where you can put anywhere up to about $50,000 into it per year. We actually have clients who put up to $100,000 per year or more in a retirement account.
So it all depends on the type of business you have, how profitable your business is, how many employees do you have? Do you want to contribute on behalf of the employees? Those are the questions you should be talking to with your advisors. Now, we have a lot of clients, I mentioned earlier, we have a lot of clients that are investing in notes and trust deeds, similar to what the Norris Group does. Now, I talked earlier about that 3.8% tax. Now, if you invest in trust deeds and notes in your personal name, all that interest income is going to be subject to tax in your personal tax return. And if you are subject to those income thresholds and you have to pay that 3.8% tax, that interest income is now subject to the 3.8. So why not utilize a self-directed retirement account to invest in trust deeds inside the retirement account? These are an ideal asset class for your retirement account, something you really should think about.
Yeah, the key with retirement planning, though, is, I mentioned some of the more powerful ones where you could put a lot more money away. The key with that is a lot of those actually need to be set up before the end of the year. Okay, you may not have to fund it until next year, but they have to be opened by year end in order for you to be able to contribute to that and get a deduction for this tax year. And later on, Karen Hall from UDirect IRA Services is going to talk to you about the wonderful world of self-directed investing. But just know that there are so many opportunities to pay yourself rather than pay the IRS. And this is definitely a key area that you want to speak with your advisor on between now and year end.
Yeah, now so far with respect to the retirement accounts, we've been talking about those kind of plans where you can put money in and get a tax deduction now when the money goes in and it grows tax deferred. But the cool thing is there are accounts out there, and we're going to talk about them, where you can actually, especially in the times of uncertainty, you can kind of take away the uncertainty of what's going to happen with the tax rates. Maybe take yourself out of the tax equation, if you will. And those are with Roth IRAs or Roth 401k.
So what's a Roth IRA? For any of you who don't know, Roth IRA just means that your ability to put after-tax dollars into a retirement account, and in that retirement account, that money grows tax-free permanently. Okay, so that whether that's rental income you're getting or capital gains, it's free from all types of taxes once it's in a Roth account, and that's why it's so powerful, especially if you believe that taxes as a whole is going to be going up in the foreseeable future. It really would be beneficial to at least consider putting money into a Roth or converting your retirement money into the Roth bucket so that you have at least one source of fund that's permanently protected from income taxes.
Yeah, as an example, we have a client that lives here in Southern California named Bill, and he uses Roth IRA to invest in a company that recently got their patent approved. They do, what is it called? It's gun parts for safety and accuracy. And they got a patent approved where they're licensing their product to manufacturers, gun manufacturers. And so they got their patent approved, and now his Roth IRA is actually collecting royalty income every month. And I think the last time we talked to him, it was about $800 a month that he's getting into his Roth IRA. So that's about a little under $10,000 a year. So, I mean, think about it. That's $10,000 a year of tax-free income to him.
For the rest of his life.
For the rest of his life. And he can, he's past retirement age, so he can pull that money out if he wants to live off of it. He can leave it in there and let it grow, continue to grow tax-free. That's the benefit of the Roth.
And what I love about the situation with Bill is because of the investment he made, we know it's going to, the return is going to just continue to grow. We actually helped him to set up a generational Roth IRA, or actually it's called a legacy Roth IRA, which means that the asset in that retirement account is not only tax-free for the remainder of his life, but that tax-free growth is going to be stretched over the lifetime of his kids and grandkids as beneficiaries. So that's really powerful, right? If you can leave to your kids and your grandkids a bucket of money that they can receive for the rest of their life and they don't have to pay taxes on that. Okay, so this is what you're talking about when you look at tax planning. Not necessarily just looking at me or today or this year, but looking at what does that do for your family? What kind of legacy are you leaving for your family? And how can you protect yourselves from rising taxes?
So who should consider a Roth IRA? Well, obviously, any of you in the room who are really interested in tax-free income and tax-free growth.
Which I think is everybody,
hopefully
right?
So, yes. But also, if you are one of the people that really believe that taxes are going to go up, now is the time to try and lock in these low tax rates and let the rest of your money grow tax-free for the rest of your life. I mean, think about it as real estate investors, right? If you can lock in a mortgage at 3%. Now, 5, 10 years from now, if the rates are at 6, 7, 8%, you're going to be looking back and going, well, I'm really glad I locked it in at 3%. Same theory, same concept applies here, as if you pay 15%, you pay 25%, but 10 years from now, you're in the 35, 40, 45%, whatever it is, you're going to be happy, especially if you can leave it to your kids, your grandkids, that you got all that generational tax-free growth. Also, if your IRA has investments in it that have gone down in value, now's the time to think about a Roth IRA. So, for example, let's say your traditional IRA has a rental property in it, and right now it's worth $50,000, and you say, okay, I really want to do a Roth conversion. Well, let's say 6 months from now it's worth $100,000, or 2 years from now. I mean, so obviously, in today's market, with the property values have come down so much, now is the ideal time to look at converting your IRAs to Roth because the values are at significant lows.
Yeah, this is another reason actually a lot of our clients are now looking at the Roth conversion again, is because I think across the board, no matter what type of investments people have, it's dropped down a little bit in value, whether you're looking at stocks, bonds, mutual funds. So in times of low asset value, a lot of times it makes sense to turn that money into Roth, to lock in that future appreciation to be tax-free.
Also, I sort of alluded to it earlier. If you are near retirement age or if you're in retirement age and you do not need to take distributions out of your retirement account to live off of, or you don't want to, then you might want to consider the Roth IRA, because with Roth IRAs, you're not required to take a certain amount of distributions every year. Now, obviously, if it's an inherited IRA, you are required. There are rules that you need to take a certain amount out. But if it's your own IRA, there is no required distribution. So it's really cool. That's how one of the ways you can leave it for your kids and let it continue to grow without touching it if you don't need it.
Another one is anyone who may have an estate issue. So you would have estate tax problems. A lot of times it makes sense to convert, because by converting you actually lower your taxable estate. So that's just pre-planning for the future in terms of how much estate taxes you would owe. So you're leaving a better asset to your beneficiaries and at a lower estate tax rate.
And again, if you really like the idea of leaving tax-free income, tax-free assets to your kids or your beneficiaries, then you really should consider the Roth IRA. Now, I know in my experience of working with clients over 15 years, I know there's some clients that they're not interested in that at all, and it doesn't matter, and that's their choice, and that's fine. They don't want to pay taxes now to leave it something for the kids, and that's fine. And if that's where you are, then this may not be for you. But if you really do like the idea of tax-free income for your beneficiaries, then really consider the Roth IRA.
Now, how many of you in here have actually used one of those free online softwares that told you, if you were to convert your Roth IRA, how much taxes you'd be paying? I know there's a lot of those free online softwares. Anyone use those?
Anyone want to admit it?
Nobody? Oh my gosh. Am I the only one? What's interesting about those is, I actually talked to a lot of people who use those, and generally they're very shocked at what they find. That by how much taxes that they would have to pay if they did a Roth conversion. It's typically people who've heard us speak. They'll go home and go on this free calculator, and it's going to say, oh, well, now you owe $100,000 in taxes or $50,000 in taxes if you want to have a tax-free life down the road. But keep in mind, before you use those software, what's missing from the software is it can only tell you how much taxes you would be paying at the highest rate. What it can't tell you is what are the strategies you can use to minimize your taxes as you turn money over to the tax-free bucket, right?
So let's go over a few of those strategies so you guys can see if any of these work in your situation. So the first one is actually not even converting to a Roth. It just talks about contributing to a Roth. So there's Roth IRAs and there's Roth 401ks. Now, for a Roth IRA, there are income limitations in terms of how much you can make, and they may say if you make too much, you can't contribute to a Roth IRA. But maybe your employer, if you work somewhere that offers you a Roth 401k, there's zero income limitations on a Roth 401k. So you could be somebody that makes $500,000 a year and still contribute to a Roth 401k if you have that as one of your retirement accounts.
And this year you can actually put about $22,000. Is that
Yeah,
right?
if you're over the age of 50, you can put in $22,000. That's going up to $23,000 next year. If you're under 50, you can put in next year. It's $17,500.
And that goes directly into your Roth IRA and grows for you tax-free permanently. The key with that, though, is that contribution has to be made before December 31st. Okay,
Well, the contribution doesn't. Well, the Roth
contribution
401k
has to be made before
Right.
December 31st,
Right.
unlike regular IRAs where that's what we're typically familiar with. You can wait until April next year and fund, okay? But if you're talking about a Roth 401k, that has to go in within the next 50 days.
And if you haven't been doing this through your employer throughout the year, I'd urge you to sit down with the HR or your payroll person, whoever it is, and see if there's a way that you can kind of catch it up, if you will. Now, they may want to just take it out of your remaining paychecks. That's usually what happens. But some places will actually let you put the money in as a kind of a catch-up contribution. So it just depends on where you work in your employer. Now, strategy number 2 is that maybe you have some favorable tax positions or some tax attributes that are sitting out there that you can utilize and time with your conversion to maybe offset the impact of the conversion so it's very little cost out of pocket to you. So maybe you've got charitable deduction carry forwards you haven't been able to utilize in the past. Maybe you've got tax credits A big one we see a lot in the last couple of years is net operating losses.
Especially for real estate investors who've been hit hard by the market, a lot of people have suffered losses that has accumulated on their tax returns.
Yeah, we had a client come to us a couple of years ago that had just had to get out of a commercial property. It was foreclosed, just like a lot of people. They took about a $200,000 loss on that. And so they had this $200,000 loss carrying forward for them. And we sat down with them and looked at their overall situation. They had $100,000 in a traditional IRA. Said, well, you can why not convert this $100,000 to a Roth? You can offset it with this $200,000 loss. So in essence, they're paying zero out-of-pocket taxes on the conversion. And now they've got this $100,000 to grow tax-free for the rest of their life. And they still have another $100,000 of their loss to carry forward that they haven't utilized yet.
A common mistake we see on tax returns for people who aren't working with advisors who specialize in real estate is real estate losses actually are considered ordinary losses. Okay, so if you had real estate losses, you can use that loss to offset W-2 income, 1099 income, and Roth conversion income.
So meaning when you sell your rental property, if you generate a loss on the sale, that should be an ordinary loss for you. So if some people think that they can only take $3,000 as a capital loss, that's actually not true. So
I'm actually working on 2 amended returns this past week for that same exact mistake.
now the third strategy talks about unused passive rental real estate losses. So still in the rental real estate, but we just sat down with a client last week that we looked at the return. He's got a rental property that's got about $100,000 of unused rental losses sitting there that he hasn't been able to use over the past years or carrying forward. And so for him, we're going to talk about, well, does now the time make sense to look at selling that property? Because when you sell that property, any of these suspended losses, they get freed up, and you can deduct them in full this year against all of his sources of income. So again, look at, can we time it with a Roth conversion so that we're mitigating the out-of-pocket cost to him?
Yeah, and if you're wondering who is this type of a person, I would say if you're someone in the audience, if you are a real estate investor, okay, but your income was too high in the past, or for one reason or another you didn't qualify as a real estate professional to use those losses, this is a strategy that could work for you, okay? If you have unused losses that for one reason or another, your CPA has told you you can't use these right now, this is who that's for.
Now, that situation we're talking about prior year losses. But you might find yourself in a situation where you've got a lot of rental properties and for whatever reason they're generating losses in your tax return in the current year. Well, for number 4, then you may want to really think about whether or not you can qualify, or this is the year to try and qualify as a real estate professional. Because as a real estate professional, you're not limited in how much rental real estate losses from the current year that you can deduct. And so again, if you can qualify as a real estate professional and now all of a sudden you've got $30,000, $40,000 of rental losses that you can utilize, again, let's look and see if we can time it with a Roth conversion to benefit you.
And I just want to briefly touch on this because we teach about this quite a bit. Real estate professional, who can qualify? You don't need to be licensed in real estate. You don't need to be a realtor. You don't need to be a broker. The IRS has simply 2 rules. One, that you spend at least 750 hours per year in real estate. And 2, that you spend more time in real estate than you do at your other jobs or businesses combined. Okay, so that's it. Keep in mind, you don't have to be licensed to take these tax benefits.
And the last strategy here, the strategic optimization, what we're referring to here is looking at the numbers and look at what is the optimal amount that we can convert this year and pay the littlest amount of taxes. Because the point being here is that when you convert to a Roth IRA, it's not an all or nothing. You don't have to convert your entire account to a Roth all in the same year. You can actually chunk it little bits every year. And so we work with clients on this strategy to, maybe it's a 3-year strategic plan, maybe it's a 5-year strategic plan, to figure out that we're going to convert enough to keep them and pay the littlest amount of taxes as possible that year, and then we'll look at this next year. It might be, maybe we convert a little more next year. It just depends on their situation.
Yes, because the goal is you're looking at how do you move yourself from a taxable life into a tax-free life, and it generally is not going to happen all in 1 year, right?
Now, we've talked about who should consider a Roth, some of the strategies to implement, but the best part about the Roth IRA is that the IRS has this undo button sitting out there. What I mean by that is, well, technically it's called a recharacterization, so don't go Googling undo button. But what the IRS will allow you to do is if you convert money this year, they will allow you, up until you file your tax return for 2012, to make a decision as to whether or not you want to undo the conversion. Now, why would you do that? Well, maybe your IRA was invested in a property that when you did a conversion is worth 50, but 6 months from now it's worth 35. Well, obviously you wouldn't want to pay taxes on something that was worth 50 that's now only worth 35. So up until the point you file your tax return, you can go back to your custodian and say, you know what, I want to change that. I don't want to do that conversion anymore. Or maybe your income drastically changed the last few months of the year you weren't expecting. So these are some things, but that's the cool thing is that it's risk-free to you. You can always hit this button, and obviously if you extend your tax return as late as possible, you have up until October 15th of 2013.
Yeah, so what that means is, let's say you have $10,000 in your Roth IRA. You decide after meeting with your advisor that you're going to convert it to Roth, and by October next year, you've made investment with that money, and now that asset is worth $100,000, for example. What that means, you just locked in $90,000 of gain that's going to be tax-free to you permanently, right? And like Matt said, if it went the other way, if the asset went down, you can always just say, nope, never mind, I changed my mind.
So in these times of uncertainty, we know in our experience of working with clients is that some people the kind of tendency might be to not do anything, not take any action. But doing that in and of itself is not going to protect you from the inevitable changes. So what you want to do in these uncertain times is sit down with your advisor, especially before year end, and look at the things that you can implement to save your taxes for now and for the future. So maybe that's looking at old strategies that might no longer work, like 1031 exchange or installment sale, or see if it works in your situation. Look at income shifting. Can you hire your kids? Can you put your family members on payroll? What are, planning strategically to take money out of your business? What's the best way to do that to save your taxes? And look at retirement investing. Is it going to be how much can we maximize our contribution this year to reduce this year's taxes? Or maybe it's looking at the tax-free bucket and you want to put money in there for the rest of your life. Whatever it is, a lot of these things you need to implement before year end.
Yes, because like Matt said earlier, we have about less than 50 business days left between now and the end of the year. And so as we sit here on this beautiful Saturday, make sure you call your CPA on Monday to set up that appointment and meet with them. Because this could be your opportunity to make sure that you protect yourself no matter what happens with this election, no matter what happens to tax rates and tax changes.
And so, in closing, we actually gave it out to a couple of you. If you guys are interested in we have a new CD out there, top 10 tax saving strategies, especially for real estate investors.
And we talk a lot more in the CD about real estate professional strategies, real estate professional status, entity structuring. And so for all of you guys here in the room today, if you want to get a copy of this, just go ahead and stop by. We have a desk outside in the hallway, and that'll be our thank you gift to all of you.